Hello, everyone. My name is Richard Leggett. I'm the CEO of FrontierView, and on behalf of my colleagues, we welcome you and we thank you for joining this episode of GlobalView. We're in a new year, and we have a slightly new setup for GlobalView. Each month, my colleague, Elizabeth Rust, who's our senior analyst for global economics, and I will sit down for a few minutes, and we'll talk about some of the biggest global macro issues and opportunities that our multinational client base are facing at the current time. The international environment continues to pose a lot of challenges for business strategy and also a lot of opportunities, so there's always a lot to talk about. And some of these are issues actually where the outlook is highly uncertain and there's considerable debate even internally among our country analysts and economists. And we wanted to kind of bring some of that to life each month for you. This month we have three kind of headlines and three topics we're going to cover. The first one is taking stock of Omicron. The second one is, will we have a taper tantrum redux? And then the third is kind of a tease. It's lost opportunity or growth opportunity. So with that, I want to jump right in and start with taking stock of where we are with Omicron. So Elizabeth, maybe we can kick off there.
Sure. Yeah, it's actually interesting to think back to just 2 months ago when Omicron was discovered in South Africa. You saw international travel restrictions being rapidly reimposed. Stock markets tumbled, you saw oil prices drop by about $10 a barrel. And there was also a lot of consternation among our clients that this was the variant that epidemiologists were really worried about, the one that would undercut vaccine immunity and undo all the progress that the world had made on COVID-19. But by now, markets have completely recovered from the drop. And indeed, it's the same for many of our clients. Omicron is actually no longer their main concern. It's now the dominant variant in virtually all the geographic markets we cover. And most countries are in the thick of an Omicron wave right now. And yet it's interesting to note that indicators of consumer mobility for most major markets are showing a little bit of a drop, as you can see here, but by much, much less than in previous waves. And we're hearing that matched by what our clients are saying, particularly consumer goods firms that aren't seeing nearly as great of an impact on their sales as they were earlier in the pandemic. And this includes firms selling goods and services where demand has been very, very sensitive to pandemic developments. It's also interesting to note that it's a similar pattern for international travel. So even despite all of the travel restrictions that were reimposed in late November and early December, particularly on travelers coming from Southern Africa, surprisingly, global revenue passenger kilometers, which is a measure of air travel, actually increased from November to December. And we're seeing some early signs that January global flight volumes were pretty resilient, a little bit of a hit, but nothing major and nothing like what we've seen in previous waves or like we saw this time last year. So, and actually since then, a lot of travel restrictions have been relaxed as a lot of countries have essentially given up on keeping the variant out.
So Elizabeth, you sound mildly optimistic. Does this mean that our clients can, for the most part, position themselves on to essentially move on from Omicron and even from COVID-19 in terms of how they think about the future? I mean, we're still grappling with supply chain issues and we're still grappling with inflation and some of the other kind of knock-on effects, but have we peaked, and is this a time to think about moving on?
So it's true that Omicron poses much less of a hit to global demand. So we're kind of talking about the demand side here when we talk about mobility. And our base case expectation is that it's going to be the same for future virus waves, that basically we have a high degree of global immunity, whether from the vaccine or natural immunity, and that therefore future virus waves are likely, just like Omicron, to have much less of an impact on mobility and consumer demand. But that doesn't mean that there aren't some pernicious effects to anticipate in the very near term, and you referenced supply chains. So we actually see Omicron as more of a supply hit than a demand hit. And there are kind of a few examples you can point to in terms of Omicron making kind of further stressing some already stressed supply chains. For example, in the United States, you see anecdotally in a lot of surveys, particularly on the manufacturing side, the issue of labor shortages being really exacerbated by Omicron. We know that in the last 2 weeks of January, almost 2% of the US labor force was absent due to Omicron, whether they were themselves sick, they were caring for someone sick with Omicron, or whether they were staying at home due to self-isolation requirements. Another area we're watching closely is China. And we saw a bit of a softening in manufacturing activity in China in January, and that was largely due to the spread of Omicron in a few regions in China, combined with China's persistence with its zero COVID policy. So that provided a hit to output and has the potential to snarl supply chains for the next month and potentially even going into the next quarter, given the way that some of these supply chain snags tend to build on each other. And that's sort of our expectation for COVID-19 this year. It's leaving center stage, but that doesn't mean it doesn't have the potential to make things complicated as new waves arise.
Yeah, so it's in a way, it's kind of as cases start to decline, there's a lagging effect for everything else, probably by, it sounds like at least 2, maybe 3 quarters.
Yep.
All right, well, let's move on to the next topic. Actually, I'm surprised we've gotten this far and we haven't talked about Fed policy, but obviously there's been a dramatic shift in Fed policy. And when we saw this last time happen, we saw a taper tantrum. So the big question I think we have is there going to be another taper tantrum?
Yeah, I think we asked, or a lot of our clients ask us, what is going on with Fed policy? And I think that's really the secret question that they have in mind behind that, given that most of our clients are active in emerging markets. They're concerned about the possibility of broad-based currency depreciation in response to the Fed lifting rates in 2022. If you remember back to 2013, we saw a lot of that currency depreciation as the Federal Reserve even began hinting that it was due to end quantitative easing and begin raising its benchmark interest rate. Now, the Fed is virtually guaranteed to raise interest rates at its next meeting in March, and markets are pricing in expectations of at least 4 rate hikes this year. And so that's provoked a lot of consternation, and it's something that we're actively debating.
And I've heard even estimates as high as 7 rate hikes. Do you think we're headed for a broad-based currency depreciation especially across the emerging markets this year?
Yeah, so our research team has compared notes on this during one of our recent meetings, and we came to a few conclusions. Overall, we see the risk of currency depreciation this year as being notable for a select handful of markets. But based on what we know now, we think we're unlikely to see broad-based deterioration across a bunch of emerging markets at once like we did in 2013. This time is different for a few reasons. Prior to 2013, emerging markets saw high portfolio capital inflows driven by the pursuit of unconventional monetary policies in developed markets, which drove down interest rates and provoked a search for yield that led investors to emerging markets. When the prospect of higher yields in safer developed market assets returned, as was the case when the Fed hinted at lifting rates, emerging markets experienced sudden capital outflows. We're not in a situation like that today. And in fact, macroeconomic fundamentals across many emerging markets are better than they were in 2013, and that's even despite COVID-19. One conclusion we can draw from the 2013 taper tantrum is that markets that saw the greatest depreciation and the greatest degree of capital outflows were those that had the weakest growth outlooks, the highest debt levels, the highest inflation rates, in short, those that were the most vulnerable in terms of their macroeconomic situation. And so we see a small handful of emerging markets that we would put in that vulnerable category today. And those are the ones that have actually already seen considerable currency depreciation in the last several months when markets began speculating about Fed rate hike for 2022. So this chart shows us the percent change in local currency value against the US dollar since September 1st, which was when a lot of that market speculation occurred. And you can see most notable is Turkey, of course, whose currency has now lost 38% of its value against the dollar since September and is now staring down 50% year-on-year inflation in January. Next is Argentina, which has seen a 7% decline since September, and a lot of that has to do with ongoing challenges it's faced since 2018. It's still in the throes of debt restructuring negotiations with the IMF and private creditors. And some other markets that maybe haven't seen as much currency depreciation yet, but where we're anticipating further currency depreciation in 2022 include Brazil as well as Chile. So overall, Fed monetary tightening poses a headwind for these markets, but a lot of the reason for their vulnerability actually has to do with country-specific factors and policies. So for example, in the case of Turkey, a lot of this has to do with the central bank pursuing its own sort of unconventional monetary policy, dropping rates even in the face of continued depreciation and high inflation. And that's specific to Turkey. It doesn't necessarily apply to other markets. So actually, as we head into this environment, it's a good time to connect with some of our country analysts to get an assessment of how they see the macroeconomic outlook and currency depreciation risks for this year, because it's not the same across all markets.
Yeah, and it's interesting because in some of those markets that you mentioned, you can take and avoid the market strategy, right? Like I think a lot of our clients have been very nervous about Argentina for a long time, for example, but markets like Brazil, Chile, and Turkey, our clients have exposure. So in those cases, are there specific actions that you're recommending that clients should be taking to this threat of more market volatility and currency volatility?
Yeah, so there's a few things that we're generally recommending clients think about. First is simply anticipation of the risks. So anticipation, for example, of simply declining demand from consumers in those markets, particularly of imported goods due to falling purchasing power in the face of currency depreciation. Markets that see a lot of currency depreciation are also likely to see much higher inflation in 2022. And that's in an already high environment of high global inflation and all of the complications around pricing decisions that has posed. So it's not a new issue, but markets that see a lot of currency depreciation are going to face a lot more challenges in that respect. And so we recommend that clients reevaluate at greater frequency their pricing decisions in those markets, with Turkey kind of being the canary in the coal mine potentially, since it's already in this highly volatile environment. We have a playbook that we've kind of recommended clients consider, or at least are monitoring very closely what's happening. So there's a call to kind of anticipate some of these issues. CFOs can also anticipate issues surrounding capital controls that some of these markets are likely to reimpose due to currency devaluation. They can also reevaluate their FX hedging strategies. So there are a few things to anticipate, and the last one is social unrest and political instability as consumers in these markets face potentially rapid declining living standards. So a number of things to anticipate, but again, the environment, it really depends on the market, and so it's a time for sort of higher level of vigilance in watching what may happen in some of these markets.
Yeah, and shameless plug, that's what we're here for, to be helpful. You called our last topic, our third topic, and this one is very intriguing to me: lost opportunities or growth opportunities. And I'm wondering if you can summarize for our audience kind of where some of the major markets stand right now in terms of GDP compared to before the pandemic, and that'll help tee up kind of, are we seeing lost opportunity or are we seeing potential growth opportunity?
Yeah, we've had a number of clients ask us to just take stock of where GDP levels are across a number of major markets. And, as we know, every major economy in the world saw a major hit to their GDP as a result of COVID, but not all have recovered at the same rate. However, it's worth noting actually that most major markets recovered to their pre-pandemic size by the end of last year. China led the way. As you can see, it recovered to its pre-pandemic size already by mid-2020. Most other major markets reached their pre-pandemic size in mid to late 2021, but there are a few stragglers that won't recover to pre-pandemic levels until the first half of the year. These include Germany, Mexico, South Africa, and the UK. But still, across the board, this is actually a considerably faster recovery than we were anticipating, and indeed the vast majority of economists and country analysts were anticipating a year ago when vaccination was just getting underway. And so that's a testament to a really successful global vaccination rate, all things considered, obviously with some lagging in certain economies, but overall it went faster than I think most people anticipated. It's also a testament to strong fiscal responses in developed markets that helped keep global demand intact. So overall, that paints a somewhat positive picture. But there's kind of another way to look at the recovery and how we can compare different markets. And that's to consider where GDP stood in 2021 compared to where we thought it would be prior to the pandemic. And so you can think of these measures here as how much smaller that economy is now than it might have been had it not been for COVID. So India's economy is now 12% smaller than we were expecting it to be in 2021. Indonesia's is 8% smaller, the UK's is 6% smaller, and so on. And there are a couple of ways to interpret that information, and that's why I call this lost opportunities and growth opportunities. You can look at that figure and think, oh, how sad. Look at how all of these economies are much smaller than they would have been, and that's growth that we'll never get back. But there's another way to look at it, and that's in terms of the faster growth that we're expecting to see next year and in the next couple of years in these markets. Now that growth decline is water under the bridge. It points to certain opportunities. And so I would actually put India and Indonesia in that growth opportunities category, particularly India. It saw such a severe COVID-19 wave driven by the Delta variant in the first half of 2021, and its economy is just kind of getting back onto its feet with high momentum at the start of 2022. We actually have a webinar coming out this week just on that issue about India's outlook for this year, and it generally is a very positive picture. So that points to a number of growth opportunities in the Indian market this year. In contrast, I would put the UK in the lost opportunities category. Its economy has not recovered to pre-pandemic levels of GDP yet. It's in that minority of economies that haven't fully recovered yet, and its economy is 6% smaller. On top of all of that, at the beginning of 2022, it's facing rapidly rising inflation, tightening monetary conditions with the Bank of England raising rates the other day, expected declines in purchasing power, along with a payroll tax increase that's planned to be introduced soon. So overall, a lot of headwinds to the UK economy. And so you might consider it to be a little bit more in that lost opportunities category. For a multinational, it's worth looking at all of these recent growth trends alongside FrontierView's 2022 forecasts, and to utilize those in your benchmarking and also in evaluating what this all means for your investment strategy this year.
Great. That's all we have time for, Elizabeth. Fascinating. I love the topic. I want to thank you for the compelling discussion. I want to thank our listeners. As always, if you want to schedule time with Elizabeth or any member of the Global FrontierView research team, just reach out to your account manager and we'll get that set up for you. Thanks again for joining. That's all we have time for today, and I hope you'll join us again next month for more insights and 3 more compelling headlines. Thank you all.
Thank you.